The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A surprise cooling in wholesale inflation, giving traders a buying opportunity, but who is taking the bait? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Bonnie Quinn, and we are taking you to the closing bells. Let's have a look where we stand. We have been higher, we have been lower, and the only major index of the equity indices that has stayed higher all day is the Russell 2000, which tells you a lot, actually. TD Securities calling it Trump vol and saying that it's kicked off even before Inauguration Day. So here we are on the S&P 500. Will we stay there through the close? We'll have to wait and see. As I said, we had a bit of a snake of a day when it comes to those prices. Nasdaq 100 down about 1/3%. The 10-year yield holding steady around 4.78. So after that PPI data, bond market waiting to see what CPI says before it makes a decision. The dollar index was a little bit weaker after we got the tariff news that it might come in increments as opposed to all at once. It is back above 109 though again, Romaine.
Yeah, but we go back to that PPI data because if you thought a soft reading on producer prices this morning would actually embolden confidence that U.S. inflation was back under control, think again. That drop in PPI was driven largely by moderating food costs. Fresh vegetable prices actually down 15%. Rice down about 1%. And egg prices, remember, which had surged 56% in November, they only rose 0.5% in December. That's good, right? Well, guess what? You know how I do this. I'm going to give you the bad news. The components of the producer price index that matter most to the Fed's preferred measure of inflation, the core PCE deflator, that was troublesome. Airline fares, which had been moderating, resurrected now, surging 7% last month. Car rental prices up almost 3%. And deposit financial services, that was up almost 5%. And all this comes at a time when consumers and business managers are trying to figure out where prices are going to go next. Maybe that's why you're seeing so much dispersion in consumer spending. And maybe that's why you're seeing so much disruption in the C-suite. Consultancy Challenger Gray said 2024 saw a record number of CEO changes at U.S. public companies. And the average tenure of a CFO, that fell to just 3 years. And that brings us back to the economy, which is really where we want to start this show. Because forecasting where the puck is going to be much harder today than it was in the past. This morning's PPI number was a case in point as investors really looked through that data point to Wednesday's consumer price index. You saw that in Bonnie's chart. The S&P expected to move 1% in either direction tomorrow on January 15th based on the cost of at-the-money puts and calls. That's according to Citi's Stuart Kaiser. And he says that that's the largest implied move ahead of a CPI print since the regional bank turmoil going all the way back to March of 2023. And for comparison, to put this in perspective, that reading rivals the implied move for the Fed's January 29th rate decision and is higher than the implied move around the February 7th jobs report, Bonnie.
Well, Romaine, let's get a view from Wall Street now and bring in JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. So, JoAnne, what are we supposed to make of this PPI data and even tomorrow's CPI data, given that we know there's a bunch of potential inflationary moves coming from the administration just a few days away?
Yeah, it certainly doesn't make it easy for them to try to impose tariffs and restrictions on immigration in the face of what appears to be a bit of a plateau here in inflation. The Fed did a good job for a while, but there's some stickiness to the inflation pressures that haven't gone away. And so, the numbers today, a little bit softer than expected, but as was just pointed out, some of those elements are worrisome. And so, we're going to watch tomorrow's numbers pretty carefully. But overall, the economy remains strong. And let's not forget about that jobs report on Friday. And that tells us that there's less of a need for the Fed to cut rates to help the labor market. And so that could lead us to see rates higher for longer.
So what do you make of the market moves then? We have the VIX very close to 20 over the last few days. It hasn't really budged much in either direction. We have the S&P 500 doing literally twisters in one session, starting off with great enthusiasm and then sort of having that enthusiasm fade. And we have the bond market clearly throwing what at least one outfit is calling a tantrum.
Yeah, well, uncertainty is never good for investing. And what we're facing right now is more than usual policy uncertainty. And it's partly the tariffs and, their sort of sideways announcement that, we're going to gradually roll out tariffs, maybe, a month at a time, isn't actually helpful. That actually spreads the inflation pressure through time rather than getting it over with a price spike, sort of a one-time change in prices because you've imposed taxes. you'd get it over all at once. Now we potentially could see it month after month after month, and that means a sustained increase in inflation. So people don't like that. We don't know yet what's going to happen on the immigration front. That could potentially increase wages, particularly in construction, travel and leisure, agriculture. And then third, this budget deficit debt problem, right? We're not hearing anything that is consistent with reducing the deficit or reducing the pressures on the debt. In fact, we're hearing quite the opposite. So while there are certainly some good economic policies coming, notably reduced regulation, that would pave the way for, perhaps faster home building, for example, and a more friendly, attitude towards M&A. Those are all positive things for growth. But we have these worrisome issues, and it's more uncertainty. And uncertainty makes folks cautious. It makes them want to buy bonds, and it makes them want to potentially take some wins off the table, or at least reduce some exposure to some companies that might be more vulnerable.
I am curious, though, JoAnne. I mean, are there sectors of the equity market that could potentially benefit from an inflationary scenario?
Well, so the not necessarily inflationary scenario. I mean, potentially a steeper yield curve, could be benefiting to banks. Obviously, we've seen some of that. We've certainly heard a lot of talk about that. The cause of the higher inflation, though, is really what you need to think of. Try to figure out what companies might benefit. So if there are tariffs, for example, on particular products that protect domestic producers, those producers could benefit. Right. So those are the things that really means you have to get into the nitty gritty to try to figure out which companies are the winners here or the losers.
Do you see right now, at least in kind of your lay of the land, are people like hedging? Are they like sort of seeking out protection for some of the volatility that is most likely going to accompany some of the things that you just laid out?
Well, it's hard to tell from the market moves. When interest rates rose at the end of the year, we saw dividend stocks actually come down, at least those in the mid-range, because all of a sudden you had, treasuries risk-free offering even more attractive yields. So that substitution effect actually hurt some of what would be considered typically safer investments. I expect that's likely to reverse over time because, as you point out, Romaine, when there is more uncertainty like this, folks are going to want to find more ways to pad their portfolios. We focus on generating above average income, whether it's in our balanced strategy or our really high dividend yield income with growth strategy, which brings in about 6% yield. So we're trying to find ways for investors to be able to ride out this kind of uncertainty by mixing together, depending on which strategy, some growthy stocks with some higher income stocks to provide that protection, whether it's a KMI or a Philip Morris, or even in the consumer space where things are a little bit, safer, like a McDonald's or a TJ Maxx or a Target, for example, which tend to do well if things get a little rocky in the economy.
Yeah, I'm curious about that. Your Kinder Morgan and Chevron picks, JoAnne, is that based on oil prices and where they're headed, or what are you betting on in terms of energy?
Yeah, one is and one isn't, Vonnie. The Kinder Morgan is a pipeline storage company, but that pipeline makes more money the more oil flows, and it tends to be fairly insulated from oil price changes. Chevron obviously is that, a broader energy play. It goes all the way from oil down to chemicals. And so it's, we think, well positioned to benefit from more lax regulations in fossil fuels in coming years, which means more supply, which means more to sell. We also think that globally, while things are a bit soft, say in Europe and in Asia, we're still watching China very carefully. Again, the U.S. economy is pretty strong, which sustains demand for oil. And so we don't see a whole lot of downside exposure in oil prices. We think Chevron is a good way to have exposure there, and they offer a pretty nice dividend, and Kinder Morgan even more so, a pretty nice dividend.
All right, well said, JoAnne. Got to leave it there. JoAnne Feeney, partner and portfolio manager at Advisors Capital, helping us kick us off to the close here on this Tuesday afternoon. When we come back, a discussion about Donald Trump, whether you love him or hate him, the former and future president. He does move markets. A big question, though, as the Trump bump fades, has the Trump trade now become a trap? A deeper dive into that coming up at the break. This is Bloomberg. A deluge of political news hitting the tape today, and that includes President-elect Donald Trump's idea of a, quote, external revenue service, which he says would collect tariffs on foreign imports. His inauguration, of course, is coming on Monday, January 20th. So let's get right to it with Balance of Power co-host Kailey Leinz. All right, Kailey, come Monday, he is the president. Come Monday, he's already said he's setting up the Department of Government Efficiency. And now the External Revenue Service to collect these tariffs that we know has become a big hallmark of his campaign, a campaign promise that he intends, or at least he says he intends to keep.
Yeah, the thing is, Romaine, we don't have much more detail than that he would like to see this agency created and that he wants its birth date to be next Monday, the date of his inauguration. We really didn't get anything more specific than that. And I would point out that the U.S. already does have an agency that is charged with collecting tariffs. It's Customs and Border Protection. They process all of that, collect those levies, and deposit it in the U.S. Treasury already. So arguably, an External Revenue Service would be pretty redundant. And in any event, it would require an act of Congress to start a new revenue agency. So this wouldn't necessarily be something that can happen on day one. But what it does underscore is what you were exactly just speaking to, Romaine, which is that this is another example of Donald Trump time and again making it clear that he does intend to pursue tariffs as economic policy here, not just in terms of creating what he sees as more reciprocal fair trade between the U.S. and trading partners, but also as a means of collecting revenue, of boosting up the Treasury's coffers and to help offset ways in which revenue could go down, specifically with the many tax cuts that he would like to pursue in short order.
And Kailey, take us a little bit through the tick-tock of what we expect next Monday. So we'll have the inauguration. At what point do we start getting executive orders, and how many are we thinking we'll get?
Well, he will, based on the Constitution, Vonnie, be sworn in at noon Eastern time on Monday. He will then give his remarks, which, as we know, this president-elect does tend to speak at length sometimes. We saw that at the convention in Milwaukee this summer, and it could be a lengthy speech. After that, there will be a luncheon. There will be a parade as he makes his way from the U.S. Capitol to the White House. And then it is probably later in the afternoon that we will start seeing some of those things, the signing of executive orders, for example, taking place, as well as potentially the first confirmations of members of Donald Trump's cabinet. The Senate could head back into the Capitol and start to get those underway. The one seen as most likely is happening immediately is the Secretary of State nominee Marco Rubio, who will be having his confirmation hearing in the Senate tomorrow. Yeah,
that should probably be one of the lesser contentious hearings there. Of course, as we wait also to see about the Treasury pick as well. Just real quickly, you mentioned all these things he's going to do after the inauguration. I also saw that he's actually going to appear at the Davos summit in Switzerland, though he's not actually going to be in Switzerland. What's that about?
Well, it might be difficult for the president, once he becomes president, to leave the country immediately having taken the oath of office. We've seen a number of trips suggested, including one to visit California, which has been ravaged and still is by wildfires. There's been reporting that his team is looking at a trip there in the not so distant future. But we do know that Donald Trump is going to be very focused on domestic issues, specifically immediately after taking office, not just with these executive orders that he would like to do, as he says, day one, pardons potentially for January 6 defendants as well on that first day. But he is also going to be trying to wrangle leaders in Congress to pursue his legislative agendas. He would like to see done very quickly a budget reconciliation process, either in one or two parts, to address issues of immigration, energy, and tax reform. And the debt ceiling is going to have to be dealt with somewhere in there as well. So there's going to be a lot for him to handle here at home, Romaine.
Kailey, thank you so much. That is Bloomberg's Kailey Leinz joining us from Washington.
All right, we're going to continue talking here about the impact of Trump's second term on markets. Jonathan Levin joins us right now, Bloomberg Opinion columnist. He has a great piece out today here talking about policy speculation being seen here as the Trump trade dominates equity markets since the November election, sometimes for better and lately often for worse. Look, Jonathan, the Trump trade has been in effect, even before November 5th, if we want to be honest. It's faded just a bit. But we know that the market is now primed to really hang on every word that he says, whether in real life or, on one of the social media platforms here. What are kind of the sectors of the market that you think maybe could get a little bit of a head fake for that? Because it seems pretty straightforward what he's proposed on the campaign trail. If he makes good on that, it's pretty clear what you need to buy, no?
Oh, man, Romaine, I don't know what's straightforward about the Trump agenda, to be honest with you. It's such a difficult environment in this equity market here because, we all know that, the talk about tariffs is having a big impact in fixed income markets. So the natural thing might be to sort of flock to some of these lower duration names and lower duration sectors. But for idiosyncratic reasons, those sectors are getting hit, too. I'm thinking about staples and and sort of like snack foods that are getting hit because of the RFK Jr. nomination. Also because of the RFK Jr. nomination, you see vaccine manufacturing companies getting hit. You see green stocks getting hit. And so to be honest with you, I'm not sure really where you hide out, except to maybe look for the names of executives who have made the pilgrimage to Mar-a-Lago and maybe have a little bit more visibility themselves. I think that a lot of those names are doing better. But outside of that, I don't know what the trade is right now until we get some certainty.
Jonathan, if it's Donald Trump versus the market, how David and Goliath is that in the sense that we had this Trump trade until we had the FOMC trade, which totally, upended everything. And we suddenly had this huge backup in yields. And suddenly it was the economy and what Jerome Powell had to say that was more important.
Yeah, and the tricky thing is here, traditionally we've been able to count on a nice earnings bump, especially over, like the last eight quarters. Earnings have been great for this equity market, but this time around, I'm just not so sure because, what are we going to hear from executives? They're going to tell us basically, well, if the administration does X, we're going to try and do Y. But all we really want to know is what the heck is X?
Yeah, well said, Jonathan. Well, look, I don't know, maybe they bring some masculine energy to the table or whatever it was Zuckerberg was talking about. But it gets to this point, though, too, Jonathan, about just how dominant he will be, meaning Donald Trump will be, whether he's proposing policies or not. Every executive, they may not admit it publicly, but they clearly have an eye on what he's doing or what he might potentially do.
Yeah, they do, absolutely. And I think another important point I want to bring up is just the reflexivity between markets and Donald Trump. We do know from his first term that he keeps a close eye on stock markets. And so maybe, just maybe, our saving grace with some of these unorthodox policies is he sees the market take a little bit of a swoon, and maybe he second guesses things like this tariff policy or like some of the immigration policies that he wants to put in there. And maybe that ultimately leads us to a more moderate outcome.
Well, we'll see. We'll have your columns to take us through it anyway, Jonathan. Thank you so much. That is Jonathan Levin, Bloomberg Opinion columnist. Coming up, gaming and lodging stocks seem to be on a better footing, but Morgan Stanley says some factors could limit growth at companies like Las Vegas Sands. We'll take a look at some of those stocks next in Top Calls. This is The Close on Bloomberg.
All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start today with Instacart, Maple Bear, our favorite, an upgrade to buy from neutral from the folks over at BTIG. The analyst saying Instacart's grocery delivery model fits the bill of consumer-facing internet stocks with accelerating growth potential. He adds Instacart also is unburdened by the challenges facing some of its rideshare peers that have been dabbling in grocery. Those shares up for a second straight day. Next up, Archer Daniels Midland, the ag chem company. Bank of America cutting its recommendation to underperform. The analyst slashing his EPS estimate for the year because of the, quote, increased macro risk stemming from the U.S. election risk that he says have yet to be fully priced in. Those shares having their worst day, looks like since December 18th. Let's end things on Las Vegas Sands, the casino operator, a downgrade to equal weight over at Morgan Stanley. The analyst says potential tariffs could weigh on stocks with large exposure to China. For now, he's taken a more guarded view on China GDP, which could limit the outperformance of LVS. Those shares down about 5% on the day, and those are some of our top calls. But we're going to stick with that last one because I'm pleased to say that the analyst behind us joins us now. Stephen Grambling is equity analyst over at Morgan Stanley. Has a great note out this morning here, not only on LVS, but really on the broader travel sector. But let's start with casinos and LVS. This is all about the China consumer, the downgrade?
It's a large part about the China consumer, but it also touches on Singapore as well. But that's not really the Singapore consumer. A component of that is actually China outbound to Singapore. So there's now, even though it's Las Vegas Sands, it's entirely an Asia-based company. And so we're taking a few chips off the table in terms of our exposure to China, as our economists have taken a more cautious view of the economy there before even considering tariffs. And as you mentioned, when we look back at the last Trump administration and how that playbook unfolded when they implemented tariffs and there was a back and forth with China. We ultimately saw it weigh on the China exposed and Macau and Singapore exposed stocks back then. So we're running a similar playbook now where we'd actually say you want to focus on some of the U.S. names where we've seen reacceleration during that last window.
Well, talk about that then. I mean, take something like, I don't know, Wynn Resorts has has less exposure, I think, than LVS over there in that China-Macau region. Is that a buy?
Wynn is our preferred pick here. It's an overweight. We do like that one. It's one where Las Vegas, if you strip out the Macau component of this business, that U.S. segment is trading at an extremely low discount relative to its historical multiple. And that's because people are worried about Las Vegas and the sustainability of that business. They went from about $450 million in EBITDA to almost $1 billion in the U.S. And so the multiple has come down because people don't expect that to be resilient. And we can see that trends have already been pretty stable going against tough comparisons. And they also have a new project in the UAE, opening up a new project in a few years, which is not embedded in the stock at all. So they're getting no credit for future growth. And right now, people are assuming that the trends are going to be weaker there. So we like that set relative to OES, where Singapore has also grown its EBITDA. This Marina Bay Sands has grown from, I'll call it $1 billion, $1.6 billion in EBITDA to now closer to $2 billion. And the multiple has actually expanded for Singapore. So the expectation is higher now. Whereas for Wynn, you get that U.S. more centric exposure. You get exposure to a new growth project in the UAE, and you're trading at a much lower multiple.
Just on the US-centric exposure, not just for Wynn, but also your other favorites, Viking and Travel and Leisure, for example, Stephen, how does higher for longer impact these type of companies, and will that have an impact throughout the year?
So that's a great question. You have certainly within the cruise space, I'll start off with that with Viking, there's always a concern around the leverage that they take on to build these ships. Viking is different. They have the lowest leverage of the cruise space. They're going to be at under 2 times net debt to EBITDA by the end of the year. They're going to be generating a ton of free cash flow. We actually think that they're going to start either a dividend or a buyback potentially in the next year or two. We think that can act as a catalyst for the stock. That's a higher end consumer, mainly U.S. centric, and they're going to other markets and they're growing rapidly. So they're the fastest growing cruise company, generally exposed again to travel over to Europe and other markets around the world with secular tailwinds. Yes. One thing we point out in the note is during the last Trump administration, trends accelerated for cruise, historical trend line.
Stephen, thank you so much for your time today. Very much appreciated. That is Stephen Grambling over there at Morgan Stanley. And do stay with us, because coming up we have a host of U.S. economic data to sift through. Today's PPI, obviously, and the December CPI report out tomorrow. We're going to catch up with Vincent Reinhart, chief economist at Dreyfus and Mellon. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Bonnie Quinn. And U.S. wholesale inflation obviously unexpectedly cooling in December, thanks in a large part, as you were saying earlier, to a drop in food prices, Romaine. Now, it's likely that we will see that continue a little bit.
Yeah, have you seen the price of eggs lately?
I have seen the price.
Well, if you saw them in November, believe it or not, they actually didn't get much worse in December. They went up like half a percentage point, but that was like after like a 55, 56% jump the previous month. But that's good news for consumers. But then everybody's saying, at least people smarter than me, the economists are saying, that those numbers don't really matter. Like, you look at these numbers on the screen, I mean, for consumers that matters. I mean, I don't know if you're a fan of broccoli, but apparently it's about 15% cheaper
love it.
Now. You know, everybody wakes up looking for the broccoli. Milled rice down about 1.3%. But then the problem is all the economists are saying none of this really feeds into the core PCE data that the Fed looks at. They're looking at travel costs. They're looking at airline fares, logistics costs, and they're saying that's up. So when we get the CPI report tomorrow, I don't know. Is it going to be good news or bad news?
Exactly. And tomorrow, as we always say, is backward looking anyway. And look at those energy prices. Have you seen the price of natural gas over the last couple of weeks?
I know. I tried to fill up my natural gas vehicle yesterday. It cost me a fortune.
Yeah, there you go. Well, let's ask somebody else about this. We have the producer price index, obviously, as we were saying, coming in softer than expected, rising by 0.2%. And we get more eco data with CPI tomorrow. So Vincent Reinhart joins us to explain it all, chief economist at Dreyfus and Mellon. So how much store should be put by these data, Vince?
It depends on whether you're talking to policymakers or people on the street. Broccoli roasted is actually pretty good. And what matters a lot for people is the stuff the Fed takes out of their index to smooth. Food prices are higher. The level of the CPI is still high, and it's uncomfortable for lots of folks. For the Fed, they probably saw good news this morning. Some of that will get translated into tomorrow's CPI. Not all of it will get translated into their preferred price index, the personal consumption expenditures price index, because some of the components of the PPI that matters for that index were actually a little strong.
So in terms of an economy with a job market this strong and inflation that's actually quite confusing right now because we do still have, plenty of stickiness there in places, what would you do on the Fed? How many cuts this year, if any, would you be planning for?
So the Fed's inflation strategy is patience, that global supply chains have healed. They are getting better still. That's going to pull down goods prices. Service prices are trucking along. They're growing a little slower each quarter, and that will translate into inflation ultimately winding up toward the Fed's goal of 2%, but not this year, probably not till next. What the Fed does is wait on rates too, because the big unknown for the forecast, particularly for the inflation forecast, is what happens with the new administration. There are lots of potential changes that could perturb any inflation forecast you got now.
I am curious, though, Vince, about this idea of the difference between kind of the hard economic data and the soft economic data. And you spent a lot of time behind the scenes at the Fed and a lot of times on Wall Street as well. And I know the hard data is supposed to tell us a story. But when you see sentiment indicators and other survey data that, I guess, diverges from what the hard data is telling us, what is the conversation at the FOMC? I mean, do they weight the hard data more so than the sentiment data, or is there some sort of balance between the two?
Everybody has a prior, and it's human nature to rely on what you can count more precisely. Things you can put into tables to the second decimal get attention. That's the hard data. But part of the FOMC process is actually talking to people. That's why they have 12 Reserve Bank presidents sitting around the table. They're supposed to reach out to the community. Moreover, Federal Reserve economists know that some of the most important components in their forecast are the completely unobservable things: sentiment, household sentiment on spending and unemployment prospects, their views about inflation, how businesses feel about the upcoming changes in policy, uncertainty generally. So I think that we spend a lot of time looking at the hard data because we're looking under the lamppost, and that's what we see. Mm-hmm. But when it comes to setting monetary policy, it's not really a science. It's about forming a narrative of the economic outlook, responding to data as it unfolds, but being comfortable with your picture of the economy. And right now, Chair Powell said it at his last press conference, the economy's in pretty good shape, and he's counseling patience for what the Fed will be doing.
And one reason why I brought that up, Vince, is because when we had the NFIB data today on small businesses, we saw that optimism continue to rise. We've seen that in some of the consumer sentiment indicators. And it's kind of a flip-flop of where some of those indicators were just a few months ago. The data hasn't changed significantly. And I'm wondering if that could actually maybe help us through this for all the hand-wringing that we're doing, at least on this program, and others about a potential resurgence in inflation. If people feel good, businesses and consumers alike, does that maybe blunt the impact of that?
Be careful what you wish for, because people also responded they were a little more worried about inflation. Some of the soft measures on inflation expectations have ticked up higher. Look at the New York Fed survey, and such. So I think in terms of spending's got momentum. The nominal activity is growing in the neighborhood of 5.25%. There are fundamentals in place that should keep that going. Most of what we know of the next administration's plans tend to be supportive of more spending. So that part, I think you're right. Households are going to be a little freer with their wallets. The question about inflation is, does it put additional pressures on resources? And there, the good news is, yeah, employment growth was strong, as we saw last Friday. But it's basically been cooling to something that's more sustainable. And right now, the labor market looks like it's in balance.
Vince, do you see any problem at all with the FOMC and the Fed in general's communication policy right now? We did see an awful lot of whiplash last year throughout the year.
Oh, so look, I spent a lot of my career worrying about the Fed's communications policy, so I always worry about it. And right now, the Fed is in a bind of its own making. Because when you talk about monetary policy, it's what they do at the policy rate, but it's also what guidance they provide about the rate going forward. And guidance is about an economic forecast. And right now, an economic forecast is a forecast of the political economy. And so the Fed has to navigate changing its forecast in terms of what it thinks the next administration will be doing, but can't really tell us everything about that. For one, it doesn't want to appear judgmental. I'm pretty sure that Chair Powell doesn't want the headline, Fed thinks Trump administration will be adding to inflation. Mm-hmm. And rightly, they're not sure those policies will actually be put in place, particularly ones that involve congressional consent. So they care about guidance, and now's a really hard time to provide guidance.
All right, well said. Vince, always appreciate you taking time for us. Vincent Reinhart there, chief economist at Dreyfus and Mellon, and fan of roasted cauliflower. All right, we are going to talk a little bit about the consumer a little bit more here on the program as we count you down to the close, because Signet, this is the big jewelry company, they actually came out with guidance, and it was disappointing. Holiday sales, not quite what some folks had expected. Those shares now having their worst day since the onset of the pandemic in 2020. That's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour, and we're taking a closer look at Signet, the owner of brands like Kay Jewelers and Zales, taking a massive hit today. Worst day since the onset of the pandemic after a weak holiday season, prompting the retailer to cut its sales guidance. Nora Melinda joins us right now. She helps cover stocks for us here at Bloomberg News. I was a little confused by this, Nora. There was some commentary at this ICR conference down in Florida, and the CEO basically said that nobody wanted to buy anything at the price points that they were offering. But I was like, you're the CEO. Why didn't you just lower the prices? So what's going on? Explain to me why they had this miss, why they're guiding lower.
Right. I mean, it really is an interesting situation. If you think about the holiday season, that's when people tend to spend. And that is a peak season when you think about jewelry and that industry there. And as we know, Signet actually owns Kay Jewelers. We've got Zales and Jared. So they have quite a few brands under their purview there. But what we are seeing here is that people are really necessarily pulling back on their wallets. We still have a consumer that is stretched beyond belief. And when you're expecting people to go buy some rings and some jewelry ahead of proposal season, holidays into Valentine's Day that'll be coming up, we're actually seeing people pulling back on those purchases here.
Well, and of course, gold was at records for most of last year as well, right? Or close to records. Does that have an impact? Do they pay for that as a raw material?
Well, they actually mentioned the idea that they're going to be targeting self-purchasers, so those who tend to spend more, and particularly on lab-grown diamonds. So we are seeing a bit of a shift and more emphasis on the lab-grown aspect versus maybe the raw materials that tend to be more expensive when we think about rings and diamonds.
But I guess it's a question, though, about consumer spending overall. Because when you think jewelry, I mean, this is probably one of the more ultimate discretionary items. Nobody really needs a new ring or, a necklace or whatever.
I was going to say, are we sure?
All right, well, I'm just saying, you don't need it to survive. Let's just say that. But it gets to this idea that, are they sort of telegraphing that there is something broader afoot here? Or is this just kind of a one-time deal where people during the holiday season made some budget decisions that maybe then we get through this in, 3 months or 2 quarters?
Right. I mean, I think it's important to note that we have other retailers that have been also echoing similar situations. We had Macy's that reported, we had Abercrombie and Fitch, and they're also talking about, when we look at the outlook and what the things that they have been struggling with as we think about the consumer and whether or not they're resilient, it seems to be an issue for broader retailers, and it's not necessarily exclusive to Signet here.
Nora, thank you so much. We're going to continue to follow the stocks move, and it has been a day of big moves. That is Bloomberg's Nora Melinda there. And Romain, I just want to see if you've read the story. So you win an Olympic medal, you get a piece of the Eiffel Tower, and then you want to hand it back for something better? Well, have you seen that story?
Well, I've seen this story that apparently some of the medals that they handed out at the Paris Olympics over the summer, apparently now some of them are already kind of fading a little bit.
But it's the Eiffel Tower.
So, and I don't quite understand. I mean, I'm confused because I always thought that it was pretty much. I mean, does gold
originally I thought they were gold medals too, and just gold of gold, right? But in this case, it was a piece of the Eiffel Tower that came, that
right.
They took apart.
But still, I mean, this is like a keepsake. I mean, someone who wins these medals, I mean, this is something they're going to keep for a lifetime, probably passed down to their children and their descendants here, and this can last. I mean, how many months has it been?
It's only been a few months, but
it's been like 6-7 months,
Bonnie. That's what happens to pieces of iron and corrugated iron, right? I mean, if you had a piece of the Berlin Wall from 1989, it wouldn't be in great shape either, would it?
I tried to buy one.
Coming up, more markets.
Well, uncertainty is never good for investing. And what we're facing right now is more than usual policy uncertainty. And it's partly the tariffs and, their sort of sideways announcement that, we're going to gradually roll out tariffs, maybe, a month at a time, isn't actually helpful. That actually spreads the inflation pressure through time.
And that policy uncertainty keeping some folks on the sidelines today. JoAnne Feeney kicked us off to the close just about 50 minutes ago. Stocks aren't much different from where they were when we started the show. The S&P and the NASDAQ in the red. But I just want to point out, Bonnie, there's some bright spots out there. I was taking a look at Dow Transports.
Yes.
Up more than 1% on the day for a second straight day here. Airline stocks, trucking stocks, even some of the railroads actually in the green on the day.
Well, let's just take a look at a few of the movers because this is how interesting this market is. You have on the one hand, Nvidia, which is down 1.7% for a lot of the day. It was the worst performer in the stocks. That on the potential for more chip barriers to export, let's say. And then on the other hand, you have Vistra up another 5%. Vistra, of course, the energy company that may be responsible for some of the AI trend. It also had a huge year last year, but it's also running strong once again today. And then you have the likes of Fannie Mae. This is another policy play. We saw a nice run up in this stock and then we saw a bit of a pause. We're now close on $7. One analyst saying that if the mortgage financiers were taken out of conservatorship, that we might have something like a $35 valuation on Fannie Mae. But I mean, that's a long way off. And this is a huge run up for this stock in advance of that, Romain.
Yeah, actually, that's if you just go across all of the tapes, that's actually one of the biggest movers of the day, Fannie and Freddie. Also seen some of those quantum computer stocks.
Did you see Rigetti?
I did. Getting a rebound here. A D-Wave up about 22%. Rigetti up 44% here on the day. And you take, we don't have the yields up there, but you take a look at yields as well. There's something to keep an eye on because that, of course, that has been a big part of the story. JoAnne Feeney was talking about that at the start of the show. Just a reminder here that that 20-year and 30-year remain camped out around that 5% level. Your 10-year at one point was above 4.8%, the highest level. going back to Halloween of 2023. Spooky. Ellen Hazen joins us right now, Chief Market Strategist and Portfolio Manager at FL Putnam. And Ellen, there's been a lot of talk here about this market, about the equity market, I should say, and whether there's a buying opportunity here. People were looking at valuations a few weeks ago and saying this market was very stretched. We've kind of been in a bit of a holding pattern, consolidation. I'm not sure what we call this, but do you see this as a buying opportunity?
Hi, Romain and Vani. Thanks for having me on. We absolutely do see it as a buying opportunity, and let me tell you why. Earnings estimates, particularly for the growth part of the market, particularly for the large cap part of the market, are still increasing, and the underlying economic fundamentals are strong. Everything from the labor market to GDP to even consumer and CEO confidence to corporate profit growth are all looking pretty strong. And so, yes, we had a very strong year last year in the equity market, S&P up 25 after a 20-plus year the year before, and that doesn't happen very often. But given the strong underlying fundamentals and, importantly, the growing earnings estimates, we think that any pullback should be bought.
All right. So is there a certain area, though, or is this sort of a broad market sort of recommendation, or do you kind of recommend folks maybe steer into certain sectors or certain specific stocks?
Well, we're looking at areas that are going to see the fastest earnings growth over the next couple of years. And no surprise, over the last 2 years, the fastest growth has been in tech and in communications, right, where the internet companies are. Going forward, though, that's broadening out a little bit. You're also seeing higher growth in energy, in financials, in industrials, in healthcare. So we do think you can broaden out a little bit, but it really is stock by stock and sector by sector to see where the earnings growth is. So, for example, earlier today, I was looking at the earnings estimates for the growth index versus the value index. Mm-hmm. The growth estimates are still going up. The value estimates are still going down. Same thing if you look at large cap versus small cap here in the U.S. Large cap estimates going up, small cap going down. U.S. estimates going up, international estimates going down. Now, at some point, these areas that have declining estimates will start to level out and increase. But until then, we stick with those companies and those areas where you see the fastest growth. And to us, that still means tech and communications with a little bit of growth also expanding into these other areas like healthcare industrials.
So when you say tech and communications, do you mean the Magnificent Seven as well, Ellen? I mean, look at NVIDIA, for example. It tends to get to a certain level and then it keeps pulling back. And, I'm just curious, would you be getting into some of those companies at these levels?
We like NVIDIA here. It's a huge weight in the index, obviously, so it's dangerous to be materially underweight that stock. But look at the earnings growth and look at the demand. If you look at the last conference call that they had, or if you look at the last conference call that TSMC had, the demand for their chips is just through the roof. If you look at the Microsoft call and what they said about their CapEx spending, the demand is there. And so even though the stock was up a lot last year and up a lot the year before, we still think that it has room to run.
What about fixed income? Are you interested in it, and are you another candidate that's lining up to buy duration?
Right now, we're a little bit short duration. I think fixed income is a tale of two worlds. On the one hand, you have rates going up. The yield curve is normal again. Hallelujah. Mm-hmm. So you can buy a 10-year bond, a 5-year bond, and get over 4%. And that is a change from a few years ago. That is very nice. And so from that perspective, we're very interested in buying fixed income. But that said, credit spreads are very, very tight. And that's true not just in investment grade, but also in high yield. So we're looking at corporates, but we're very judicious about which ones we buy. We're a little short duration, looking to keep that for a while. At some point, we'll go long duration, but we're not there yet. I think that may happen fairly soon. We're also invested in Treasury inflation protected securities. So the TIPS, we're looking at floaters and other things that are going to be sensitive to higher rates. We think rates are going to stay higher for longer across the curve.
Well, speaking of inflation, Ellen, I do have to ask you just about the economic picture. We got a PPI report that was somewhat encouraging, though some economists smarter than me saying that it was kind of a head fake. I am curious about CPI and all the talk about that maybe we could see a resurgence in inflation, particularly with some of the potential policies coming out of Washington over the next few months.
I think the policies coming out of Washington have an enormous spectrum of possible outcomes. It's a very, very wide cone of outcomes right now. Everything from tariffs to immigration reform. We don't know what is going to happen. We can paint a plausible case that tariffs will be implemented in a very targeted fashion, in a very narrow fashion and in a slow and judicious fashion. If that's the case, it will probably have very little effect on inflation. Conversely, we can also make a case that tariffs will be implemented quickly in wide scale across the board and in large magnitude, and that would be disruptive to inflation. So I think you can paint both cases. We don't know, right? We don't know. I think the hallmark of this administration is its unpredictability. And I think that in a lot of ways, that's a feature, not a bug, as it relates to negotiating with other countries. But as far as predicting what's going to happen to the market, I think it's more of a bug rather than a feature.
Ellen, going to have to leave it there. Ellen Hazen, Chief Market Strategist and Portfolio Manager at FL Putnam, counting us down to the closing bells here on this Tuesday afternoon. The S&P poking into the green. Stick with us. This is The Close.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bonnie Quinn. We're here to help take you through the closing bell. It's a global simulcast, and it has already started. Carol Massar and Tim Stenovic in the radio booth. Scarlett Fu and Alex Steele have the day off. A lot to parse here, guys. I'm not sure the market reaction that we saw to that PPI report this morning was good or bad, but they seem to be taking it in stride. The S&P unchanged on the day, though we're seeing modest gains elsewhere in the Dow, the Russell, and Dow Transport.
Yeah, but it's not like it's been a straight line all day, right? Like we're bouncing around in a big way. There are some outperformance. KB Home kicking the whole home builder group to the upside. You got 18 numbers in the S&P 500 home building index, and it's up about 3.3%, Tim. So there's some outperformance today.
There is, but if you look at the index level, it's really hard to see what direction things were moving today. Yes, we finished in the green, but the index searching for direction much of the day, moving between gains and losses, more than half a dozen times today, Bonnie?
Not just that, Tim, but have you noticed the Russell 2000 was up 1.1%? It was the only equity index that was actually higher all day long. It didn't dip into negative territory at all. And it's the second up day for both the Dow and the Russell 2000. I don't really know what conclusion to draw from that. I just think it's really fascinating.
Yeah, I mean, that is what's leading the charge. It is a lot of the utility companies, materials that we were talking a little bit earlier about, railroads and airlines having a phenomenal day. We should point out volume is actually lower here. When you take all of the tapes, the ABC tapes here, right now heading into the close, we're down about 18% from yesterday. Though we'll see if that changes as some of those final trades come in here in the last few seconds. We do get the closing bells here in New York, the clapping and cheering. And, well, I guess you got a little bit to cheer about, at least if you're paying attention to the Dow. The Dow Jones Industrial Average is going to close out the day higher by more than 200 points, or roughly 0.5%, 42,515 and change. The S&P up about 6 points on the day, a gain on a percentage basis of about 0.1%. The NASDAQ in the red, down about 0.2%. The NASDAQ 100 down 0.1%. But as Vonnie was just talking about, there's the Russell 2000, a gain of 24 points, or more than 1%. S&P mid-caps up 1.1%, and Dow Transports, Carol, up 1.3.
Yeah, it makes you wonder, is it finally the moment for small caps? We'll have to wait and see. Having said that, I'm going to go back to the big caps. Look at the S&P 500, Vonnie, and you've got most names in the index actually higher today. 382 to the upside, 118 to the downside.
Yeah, if you look into it and look and see what's going on under the hood, we have many sectors, maybe 8 of the 12 sectors in the green, Carol, particularly utilities and financials, but obviously utilities had sold off big time, so that might be to be anticipated. Financials, we're about to head into earnings season, so we'll see if that can continue. And then, areas like healthcare and communication services were lower.
All right, let's get to some of the individual outperformers today. Constellation Energy, once again on that list, up about 3.5% at the close today. It was a top gainer in both the S&P 500 and the NASDAQ 100. It's just off of announcing its deal to buy Calpine, which sent the stock, up about 25% on Friday. Today, both UBS and Jefferies raising their price targets on Constellation to $329 a share and $274 a share, respectively. Jefferies has a hold rating, calls the Calpine acquisition deal positive and value accretive. UBS, by the way, has a buy rating. The stock closing at $288, just under actually $289 a share. I mentioned how the home builders, really some outperformance in the group overall, and that's because of KB Home. That stock at its highs up almost 14% in today's session, finishing the day up 4.8%. KB Home reported earnings and revenue and also deliveries for the fourth quarter that all topped average analyst estimates. The stock up the most, I should check, in intraday. It was about 2 years, but we really saw some major outperformance. The highest since about December, but up the most intraday in more than 2 years. One more for you, Whirlpool, also some outperformance, up 4.4%. The company rising to its highest since about October of 2023. Goldman Sachs analyst out maintaining a buy rating, but raising the price target from 125 to 138. Stock closing at just about 126 a share, Tim.
Okay, you got the gainers. I got the decliners. I do want to start with shares of Meta Platforms, falling today by 2.3%. The company cutting roughly 5% of its staff through performance-based termination. The company does plan to hire new people to fill those roles this year. That's according to an internal memo sent to all employees. Eli Lilly shares, the biggest drop since March of 2021, the biggest drag on the S&P 500 today. Did you see this?
I am so fascinated by the story. Did you see the reason why?
Yeah, the weight loss drugs, the GLP-1s that we've been talking about for years at this point. They couldn't make enough of them. Well, now they have too much of them. Shares down 6.6%. We're talking about Zepbound and Mounjaro, obesity and diabetes drugs, respectively. Demand skyrocketed over the past 2 years as Americans sought them for weight loss. Companies invested more than $20 billion to boost supply, now facing the problem of having more drug than it thought it needed. And I know you guys were talking about this a little earlier. I looked up and saw you were talking Signet Jewelers.
Yeah.
Worst day going back to March of 2020, down 22%. This after
so I take it
disappointing.
You didn't buy your significant other any jewelry this holiday season?
No, in fact, what they're trying to do is have more jewelry that will appeal to people who are shopping for themselves.
Oh.
Engagements are down as well. That's a huge issue.
Okay.
Lab-grown diamonds.
Uh-oh.
They didn't have enough supply of those. Those are less expensive, obviously. Mm-hmm. And then gold jewelry as well. They didn't have enough supply of that. That's what people wanted. They didn't necessarily have the right product mix.
Yeah.
So sort of a perfect storm brewing.
Can I just say, I don't envy like retail CEOs.
No.
I mean, I just feel like
Really
trends
tough.
shift so fast, and I don't know how these people actually do it every day. I mean, I know they have a whole team who are supposed to sort of figure it out, but I don't envy them at all. I just want to point out too, just on the stock front too, guys. I mean, I was just taking a look here. The outperformance that we saw from small caps relative to large caps. One of the biggest gaps that we've seen now going back to November, at least if you measure it up against big tech and the Mag 7 and things like that. Just pointing that out. You see yields on your screen there. You did actually see a drop in yields on the short end of the yield curve, but that was primarily just for the 2 and the 5-year yield, and that was only by about 1 basis point. So your 10-year yield pretty much went nowhere. At one point, it was above 4.8, but it's going to settle today pretty much unchanged. And you did see a slight bump in the 20 and your 30-year yield on the day.
All right, we're waiting for a lot to come at us, right? We've got another inflation print this week. We've got big bank earnings, a lot going on. And yet, what really caught our attention is we're starting to get some early indication on the congestion pricing in New York City and whether or not maybe it's actually having an impact on the traffic in and around New York City streets. Well, we found traffic actually dropping by about 7.5% during the first week of congestion pricing, Romain.
Yeah, we're just going to get to some earnings real quick here, Carol. This is on Applied Digital. Crossing the wire right now. The adjusted loss per share coming in at 6 cents a share. And believe it or not, that's better than expected. The street was actually looking for a loss of 13 cents a share. So a little bit of an improvement there in the company's financials. Revenue pretty much in line with estimates, 63.9 million. Just want to make sure I get that right. Street looking for 63.4, shares up 7% in the after hours.
Yeah, we should point out, too, they were up about 10% in today's session, right? They actually signed up a deal. Macquarie, right, will invest up to $5 billion in their data centers being built by Applied Digital. So that gave it a big boost kind of ahead of the earnings.
And why would you bet against data centers at this point, right?
Well, because maybe we need the energy to
Hey, that's why the energy. That's why the energy companies are still gainers every day. For
I'm
you,
a little
Carol.
concerned about the climate. Have you? I'm just saying.
Okay, good segue for us to talk more about congestion pricing, I guess.
Well,
I think
can I tell you about this?
Please.
I kind of forgot this existed, and then I was like looking at my Easy Pass thing or whatever. Oof. So, like, you get charged $9 for coming into Midtown, basically the central business district. Yeah. Then if you leave, you do get charged again, I think, or something.
No, it's just one charge for the day.
Yeah. But anyway, I mean, that's pretty hefty. I know they give a discount for like taxis and Ubers, right?
Yeah, they do. Yeah. The whole motivation here, though, is to reduce congestion in the central business district, of which our office is in, but then use that money to then support the public transit options here from the MTA. So the idea is that the subways get better, the trains get better, the buses get better.
Really? Okay.
The environment, less pollution.
I rode the subway today.
Well, apparently they're going to be
better.
Well, they're putting police officers on the subway now overnight, every night. So that has potentially something to do with this idea that people have to use the subway a little bit more often with this congestion pricing, because it's pretty onerous. Peak times start at 5 a.m. and they go to 9 p.m. on a weekday.
To 9 p.m.? Mm-hmm. All right. What are we chatting next, guys?
CFA rates.
That's right.
Romain, you should be keeping track of this because I know that you are the king of the CFA here at Bloomberg.
Yeah.
CFA rates.
I'm just a prince. Don't overstate it.
They did stay elevated, the pass rate, but still nothing like you would imagine, falling to 43% above the historic average. But that's a lot of people that are failing the CFA every time. Now, first-time takers did particularly well.
Yeah.
They had a pass rate of 49%.
Yeah, these are the level 1 takers. So these are the of the 3 levels out there. This is the first one, technically the easiest one. But I mean, this is a notoriously difficult exam. I did power my way through it, though not to brag. But it is difficult, and the pass rates. I should point out the pass rates when I took it were even worse. So they've actually improved.
So you're better. That's what you're telling us, right?
Well, it was harder when I took it.
How many times did you have to take it?
Oh, no.
Oh!
I did not pass. Well, I passed level 1 on the first try. Level 2 took some time,
I bet
but I
you
got
did
there.
well.
And then
I bet
level
you
3.
did.
That's a journalist right there, Carol.
So. Doesn't matter how you get there, Carol, as long as you get there.
You still passed, right? You still passed.
I got my certificate, and it's on the wall, and it's glorious.
It's very cool.
Put it in the living room.
All right, well, congratulations. All right, guys,
I had to take down my grandmother's picture and put it right there.
What?
She didn't have a CFA, you see. If she had one, you would have left it up.
That's harsh. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Folks, we will see you again, same time, same place tomorrow.
All right, coming up, there has been a huge shakeup in C-suites over the past few months. Just today, we learned about J.P. Morgan's Daniel Pinto basically stepping aside, Jennifer Pipes stepping in. This is coming after a record-breaking year for executive exits. We're going to talk about that when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, now that the market is closed, let's take a look back at this day in history, the day when the star was born. January 14th, 2004, that was when J.P. Morgan Chase said it would buy smaller rival Bank One Corp for more than $50 billion. The deal gave J.P. Morgan access to Bank One's $290 billion of assets, 7 million retail customers, and 500,000 small business clients. But the biggest prize would be the onboarding of a 40-something Wall Street wonderkin named Jamie Dimon, who had been running the Midwestern Bank One since being ousted in 1998 from Sandy Weill's Citigroup. In fact, the acquisition by J.P. Morgan, then the second biggest bank in the U.S., is widely believed to have been a direct challenge to Citigroup's then dominance in the space. In bringing in the brash young executive in Dimon, who had spent 15 years helping Weil build Citigroup into a behemoth financial empire, well, that proved to be much more than just the icing on the cake. Within 2 years of the deal being announced, Dimon would be elevated to CEO of the combined J.P. Morgan Bank One, taking over for William Harrison, who had joined its predecessor, Chemical Bank, in 1967 and helped engineer some of the biggest bank mergers in history. That included acquisitions of Chase Manhattan and of J.P. Morgan. Bank One would be his last major takeover, and it would set Dimon off on a 19-year run as CEO. And that brings us to our question of the day. While Jamie Dimon is the longest-serving CEO of a major U.S. bank, he's not even close to being the longest-serving in the S&P 500. So who does that title belong to? This should be easy, guys. Warren Buffett, who has held the title as CEO at Berkshire Hathaway since 1970. Among some of the other notable sages of the S&P, Alan Miller, who's been running Universal Health since 1979, Stephen Schwarzman, who's been atop Blackstone since it was founded in 1985, and of course, who can forget Jensen Huang, who has of course been at the helm of NVIDIA since its inception back in 1993. Now, no matter Jamie Dimon has earned his flowers since taking over J.P. Morgan, well, he has risen the bank to be the number one bank in the country, and the increase of more than 500% in the company's stock during Dimon's tenure is 6 times the gain than the S&P Financials Index, and that has helped turn him into a billionaire. As for when he'll retire, well, I dare you to ask him that question.
Well, Romain, I'm not going to do it, at least not tonight, as he's preparing for earnings tomorrow. But I'm sure he would say that he's not done yet. The race to succeed Jamie Dimon getting a bit more blurry, in fact, today. Newly announced COO Jennifer Pipsack taking herself out of the running as a CEO candidate. But get this, quote, at this time. That's all according to a spokesman. Joining us now is Bloomberg's Sally Bakewell covering finance. We're reading a lot into this little phrase that she's taking herself out at this time. Are we overthinking it? Is she just taking herself out of the race? She doesn't want any speculation on the fact that, that there's another rung on the ladder that she could possibly attain if she wanted to?
So we have reported before about her reticence to take this top job. So I don't think it is actually hugely surprising that she actually came out and said today specifically that she isn't considering herself as CEO. It does indeed leave the door open potentially for that role. But I think the big question that still remains, despite these announcements today, is when will Jamie Dimon step down and who he will anoint as successor. And indeed, Pipsack had been considered a front runner, and almost as soon as the statement hit this morning saying that she would now be Chief Operating Officer, taking over from Daniel Pinto, who retires at the end of 2026, almost immediately we learn that she does not want to be considered as a potential CEO.
I know, but which kind of makes me want her to be CEO. I feel like the people who don't want the job are usually the ones who probably are more deserving of it. But it raises the question, when these headlines came across the terminal this morning, I didn't know what was the bigger news, that she was elevated to what some people are going to look at as a potential path to being CEO, or the fact that Pinto was leaving. What was more surprising to you?
I think the big question for a long time is who is going to succeed Jamie Dimon. I think
there's only one person that can answer that question.
Right. And if we look at who the potential candidates are now, that if we can take her word for it, Pipsack truly is out the running. Well, she was promoted to run the commercial and investment bank with Troy Robar. So I think her ruling herself out potentially spotlights him a little bit more. We also have Marianne Lake, who has for a long time been deemed a contender. She runs the Consumer and Community Bank. Now, this also throws a new name into the mix with Doug Petno, who takes over from Pipsack. Now, he has had some pretty decent promotions in the past year. His rise has been pretty fast, so he now is potentially one of the contenders.
And, of course, Mary Erdoes. We don't want to forget Mary Erdoes as well. So that's a lot of people that could potentially take over JP Morgan. Just, if you were ranking them, would they all be good? Would they all be able to do the job?
I think they've all been positioned in such a way that they remain potential candidates. We heard that UBS's Erica Najarian thinks Lake is a strong contender. We might find out some more when JP Morgan reports earnings tomorrow morning. There may be some further hints. But I think at this stage, these announcements, rather than making us any wiser, have actually potentially made us a little bit more uncertain. And we certainly know that the CEO role, they need time to figure out when Jamie Dimon can step down and who takes over. They probably need at least a year, so we can potentially contemplate that a new CEO wouldn't be in place until at least early 2027.
All right, well, a lot of palace intrigue, whether they want it or not, of course, for the biggest bank in the U.S., Sally Bakewell. A conversation here about Pinto stepping aside and some of the folks that have been elevated. And let's face it, folks, we've seen a lot of shuffling in the C-suite in 2024, and we're already seeing it at the start of 2025. From Southwest to Panera, just to name a couple of companies. And there's new data out from recruitment firm Christ Colder, showing finance chiefs in the S&P 500 spent an average of 4.9 years in their role in 2024. That was actually slightly up from the previous year. Nina Trentmann is a senior editor here at Bloomberg, and she is the author of our CFO Briefing newsletter. Talk a little bit about this, because I feel like every day I come into work, I'm seeing another headline of a CFO leaving, or they're searching for a new CFO or a COO or something like this. Is this just in my head, or are we actually seeing this show up in the numbers?
Well, it certainly feels as if there has been an acceleration of people who are changing jobs. If you look at the latest Chris Colder data from last year, it showed that the number of CFO changes was approaching 15%, which is a 10-year record. And so I guess that illustrates a number of things. First, companies are looking to see, do we have the right people in the role, especially here in the U.S., where companies are facing a new administration.
Let me just stop you there, because what is that role? Because it's not like just being a bean counter, and you kind of front ran me there with the administration here. I mean, we're entering a much different world, potentially.
Right. Yeah, I think it's fair to say that it's not just a bean counter role. It used to probably be that, but we go back 20, 30 years. Now, what we're hearing increasingly from recruiters and from companies is that the CFO role is very strategic. So it's basically the number two to the CEO, and increasingly we're seeing these people take on additional roles in supply chain management, in procurement. We're thinking about Trump, that also potentially means tariffs. CFOs will also play a more important role there. And so I think what we're seeing is that the CFO is in this position where they are seeing a lot of things. They're basically seeing all the numbers, and they're seeing what's going on inside a business, and that is increasingly a broader role. And so I think it's interesting to see that we have seen this increase in turnover. Of course, we're also seeing this, that more baby boomers are retiring. That is also something that is driving fluctuation and change. And I think we'll probably see potentially more moves this year because companies are realizing, okay, well, the new administration is bringing new policies and new challenges for companies, and they might realize, okay, well, are we really well prepared?
So there's been a change in the amount of CFOs, the turnover, the tenure, and so on. What is the state of mind of the CFO going into a year where all of that is on the agenda? And it sounds terrifying to me.
Yeah, to me too. The interesting thing is if you look at recent surveys, you see that many CFOs are pretty optimistic going into this year. So recent data by Deloitte, for example, indicated that 67% of CFOs say now is a good time to take risk, which is significantly up from the 2-year average of 37%. So it seems that whilst people are aware that there's uncertainties and there's risk, they seem to be more on the optimistic side, and I guess we'll see what this new administration does and how this plays out, and if it actually is justified.
I'm going to ask you a question. Maybe you can't answer it, though, but just getting back to the Jen Pipesek thing at J.P. Morgan and the idea that she would kind of publicly state that she doesn't necessarily want to be, or not publicly state, but that she stated that she didn't want to be a CEO. Do you find that there are folks out there like that, kind of these folks who are in the C-suite, but they don't necessarily want to be king or queen? They kind of are happy just being kind of that second or third level down, I guess, where you have, a little bit of money, a little bit of power, but not all the scrutiny that the person at the top gets.
Yeah, I think it's fair. There is, if you look at executive careers, there is a fair amount of people that become CFO, and then they become CFO of a bigger company, and then another CFO. So there are these people that stick to that role because they found it and they like to operate in it. But we're also, of course, seeing an increase in people who become CEOs. So that was also one of the trends in recent years that Chris Calder pointed out. I think between 8 and 9% of CFOs become CEOs. So you see also that the CFO position is increasingly that bench for people to then ascend to the top spot. Plus, we're also seeing CFOs adding additional responsibilities, like, for example, taking on additional roles as president, which Harley Davidson just did. So we're also seeing sort of that expansion of the role.
And as you say in your latest newsletter, the criterion that people are looking for right now has been there, done that. So they want CFOs that have seen it all. Our thanks to you. And
for the record, I wouldn't mind being a CEO. Can you work that out for me?
A CEO or a CFO?
Well, do I have to be CFO first and then
no,
I'd rather just get all that process.
I'll try.
That is Bloomberg's Nina Trentmann. Thank you so much for joining.
All right, we're going to pivot from that here, and we're going to continue talking about the world of business and how business leaders view it here. Because, of course, some of those big C-suite CEOs and CFOs are leaving because they're concerned, but small businesses, believe it or not, they're feeling better. The latest U.S. Small Business Optimism Index reached its highest level since 2018, and that was driven by expectations of favorable policies coming out of the Trump administration. Donald Trump, of course, will be inaugurated on Monday, and it'll be interesting to see what happens next. Carol Roth, she's the author of You Will Own Nothing, and quite frankly, she's a leading small business expert. You know her, you love her, she's right here on The Close. Carol, let's talk about these numbers, because we focus a lot on the show, of course, on the big, gigantic corporations. These are the corporations that, frankly, they can deal with anything. They're supposed to deal with anything. That's why they get paid $20, $30 million to deal with Republican administration, Democrat administration, anything in between. Small businesses are in a much different bind here, and yet they're feeling pretty good right now about what they think is going to happen over the next few months or so.
Yeah, Romain, we like to talk a lot about Wall Street, but we forget that Main Street is such an important part of the economy. Almost half the jobs, certainly 99% of all the entities out there, and 6 million of those who are employers. So this is a really banner day for small business optimism. We've had this small business malaise ever since really about COVID, and small businesses have been burdened first with closures, then with supply chain constraints, not enough labor, inflation, regulation, just on and on and on. So the fact that we see the NFIB Small Business Optimism Index not only surpass expectations, not only have a huge overall jump, but the fact that we are now back to 2018 levels and sort of wiping out that malaise of the last 5 years or so really is a huge thing for small business and certainly for the growth strategy that the new administration wants to pursue.
I am curious, what are small businesses most exposed when it comes to like government oversight or government sort of meddling? Are they more exposed to federal rules and regulations or state and local ones?
So historically, it really has been more state and local regulations, but we have seen the federal government get involved, particularly with the last administration, with more bureaucracy, tape, and rules and things that impact small business. One of them is a rule that they have to register with the Financial Crimes Enforcement Network of the Treasury, which is being fought. Certainly on the labor front, the use of independent contractors is something that small businesses are very heavily dependent upon, and new rules were instituted by the Biden administration. So really what small businesses tell me all across the country is that they're not looking for special treatment. They just want, whether it's state or local or federal, they want the scales to stop being tipped in favor of the big guys, and they want less red tape so they can focus on running their business and growing their business instead of that bureaucracy.
Carol, was this survey done before we knew that the Fed was going to stay higher for longer, and will that have an impact on the enthusiasm of small business owners?
It's a really good question, Bonnie. This is a December survey, so it gives us kind of a snapshot of what it looked like last month. I think that small business owners aren't as plugged in and kind of focused on the moves of the Fed as perhaps the three of us all are. And certainly I have my own opinions of how that's going to affect access to capital. But the small business owners are really so focused on the kind of ins and outs of running their business that, whether something shifts 25 or 50 basis points in one direction or another, that's not really going to impact them. They don't have the ability to take down that capital at the same levels that Wall Street, has historically, and it's just not as much of a factor. Certainly, if we see a very big shift in tone to a hawkish tone, I think that will end up showing up in future reports. But right now, small business is all just completely focused on, hey, we have more certainty potentially around taxes, that we should have a lower regulatory environment, that we should have more growth, and that's what they're all in on right now.
All right, Carol, great stuff. We got to get you back for a little bit longer sometime. Carol Roth, author of You Will Own Nothing, a leading small business expert, coming to us here on a day, Bonnie, when we got that small business optimism index. And one thing I thought was interesting, there was a great story on the Bloomberg Economics showing that gap between the hard data and kind of the soft sentiment data. And the idea that right now, that the data is kind of pointing more pessimistic, even though the optimism index is pointing more optimistic, obviously. But it was kind of the flip side of that just a few months ago, prior to Trump being elected.
Yeah, and you got to love to see it. You want to see these small business owners being very optimistic, but you've got to have these worries as well, particularly the labor situation. I mean, we're seeing this great run of jobs reports, which is great for the U.S. economy, but is it really great for the small business owner who has to compete for the talent, who doesn't know what kind of immigration policies are coming in? And have they really considered that when they're answering these surveys?
And that's the big question here. And of course, we have to wait until the administration actually comes into power on Monday. They've made it clear on the campaign trail of what they plan to do. It'll be interesting to see the follow through. And we talk about all of these changes going on in the business world. It's just so many changes right now. And maybe that's because people are positioning for what is going to be kind of a bit of a new world order. In fact, we had some changes coming up here at GoodRX, a big pharmaceutical company that's really been trying to change the way that we buy drugs, kind of make it more affordable. Well, they also have a new CEO, Wendy Barnes. She's just weeks on the job, but already making waves. We're actually going to have an interview with her coming up after the break, right here on Bloomberg. Digital healthcare firm GoodRx kicking off the new year with new leadership. Its new CEO just only about 2 weeks on the job, but pleased to say she actually joins us now from the JP Morgan Healthcare Conference out there in San Francisco. Wendy Barnes is the GoodRx CEO, and she's sitting down right now with Open Interest co-host Katie Greifeld. Katie.
Romaine, thank you. Yes, I'm here with Wendy Barnes. And as Romaine said, you took over January 1st. You're a total of 2 weeks into the job. So I want to talk a little bit about your background. You have a really interesting resume. You spent your career working with pharmacies, drug manufacturers, and PBMs as well. How will that background inform how you lead GoodRx?
Yeah, no, it's a great question. Thanks, Katie, and thanks for having me. Thanks to Romaine as well. Candidly, it's why I took the job. So I've spent so much time in and around this ecosystem. And as you mentioned, let's just start retail pharmacy. So saw firsthand the challenge that is showing up to the pharmacy counter and either not being able to afford your drug and abandoning it there, or simply not understanding how to navigate your coverage. Inside PBMs, similar construct. The ability to support employers who need to save year over year necessarily drives more drugs off formulary. That also is an incredibly frustrating component for consumers when you're at the counter. And within Big Pharma, their challenge is getting brands into the hands of patients and consumers. The more that fall off formulary, in addition to confusion as how to even navigate their programs, you put those pieces together. And when I saw the opportunity at GoodRx, who really sits at the nexus of all of those components to really be that complement to insurance and or when it's completely not covered, it's just a pretty exciting opportunity.
Well, with that in mind, let's talk a little bit about how GoodRx actually works, because, of course, consumers know it as a place where they can compare prices. But when I was, Googling to prepare for this interview, one of the Google suggested results was, how does GoodRx actually make money? So I'll turn that question to you.
Sure. In a couple of ways. I would start with your general Google on finding, a fair price through our consumer front end. Yes, that is our core business. And historically, Trevor and Doug, who founded the company, did that by contracting through payers, largely PBMs, to access their pharmacy networks and discount pricing through those networks. Flash forward to today, while we still do that and we integrate with payers, we additionally go direct to retail pharmacies to contract directly with them to provide pricing at the point of sale when it can be more competitive than going through that secured pharmacy network, which is the benefit side. Additionally, which is a little bit new in the last year and a half, we're now partnering directly with pharma manufacturers to get brands into the hands of patients who otherwise are abandoning those scripts at point of sale. So that's a little bit of a new concept in that historically we primarily focused on generics, and now we're expanding brands. I think we doubled in 2024 from 75 partnerships to about 150. Obviously, that's a really small microcosm of all of the brands that are available. So you've kind of got this pharma connectivity as well. And of course, pharma will pay us when we partner with them, when we do that, when we buy down that price at retail pharmacy. Additionally, in partnership with pharma, so big manufacturers, we're also providing through our front end access to their patient affordability programs. So think about all of the enrolled programs with, say, brand.com, just fill in the blank for any brand. It's pretty confusing as a consumer to know how to get to those actual brand pages and to have trust that what you're doing is the appropriate action, if you will, to get enrolled in those programs. So we're also redirecting in partnership with pharma. We're getting patients enrolled is another mechanism through which we're partnering with pharma. And in that direct partnership with retail as well, we have the ability to provide that brand conveyance, where today they're on the whole losing money when they're doing those without partnership with us. So those are three of the bigger buckets.
Well, Wendy, this is Romaine in New York. I am curious. I understand how that works, particularly with some of the drugs that maybe aren't as in demand or maybe in the zeitgeist. I do want to ask you kind of the standard GLP-1 weight loss question, because when you have a hot drug like that everybody wants to get their hands on, you have a shortage or some degree of a shortage here. Yeah. I mean, how much leverage do you have going into the room with a Novo Nordisk or an Eli Lilly to try to negotiate prices for something that effectively they can't even keep in stock?
Yeah, well, I think, as it relates to GLP-1s, you're absolutely right, Romaine. I mean, the opportunity is certainly endless. Having said that, if we kind of reframe that in terms of where does the leverage actually exist? They're struggling to get coverage for those GLP-1s, and that is precisely a place where GoodRx can play. If they're not getting formulary coverage, that means that those prescriptions after a healthcare provider is writing it are largely getting abandoned because the consumer can't get access to it. So those conversations actually make a ton of sense for drugs that are new to market that are struggling for formulary coverage. We have the ability to provide a cash price at point of sale. Now today, what we're doing in partnership with those same manufacturers is largely redirecting to their own brand manufacturer copay coupons, but there is a huge opportunity for a price, a cash price at point of sale, and we're actively in those conversations.
Interesting. And I mean, when it comes to cash pricing, talk to us a little bit more about those potential discussions that you're having. As Romain highlights, I mean, GLP-1's so hot right now. It's obviously one of the topics of conversation here. So if you could bring us in a little bit to those discussions that you're having, that would be very interesting.
Sure. Well, let me back up a bit and just start with their own manufacturer copay coupon programs. So there is a lot of misunderstanding amongst consumers on how to even access an Ozempic.com or fill in the blank for one of those GLP-1s, and to include amongst physicians as to how you're supposed to get access to their own discounted pricing. So we're already partnering with those manufacturers to help redirect and support, because all of those consumers are already looking at GoodRx for those drugs. We're engaged with 30 to 40 million unique consumers who fill drugs with us today, but they're also searching for drugs that we can't fill. And so what we're doing is we're letting pharma know in those instances, and in this example, those same manufacturers, do you have any idea the hundreds of thousands of clicks we're getting from consumers trying to get access to your drug? And when we can support them then getting to their actual brand launch page, we're able to get them enrolled in that discount program through our front end. And typically they're seeing a lift 5 to 10 times higher when accessing through us as opposed to just putting their brand.com out in the market. So that is certainly where those conversations start. And then it's turning into, and oh, by the way, the number of prescriptions that are abandoned at point of sale, you have an opportunity to provide a cash price at point of sale. And here's why that makes sense for you. And we've demonstrated it with other brands, and we're showing them those results. Hence, the conversations are ongoing as to what that point of sale cash buy down could look like.
Wendy, in the broader space here, in terms of what you're doing at GoodRx, I am curious about some of the changes coming out of Washington and whether the general business model that we see with pharmacy programs and pharmacy benefit managers could change. Are you anticipating any significant changes in some of the rules and regulations out of Washington that would have a direct impact on your business?
Sure. Well, gosh, I think, generally speaking, with any change in administration, your guess may be candidly as good as mine. There are a few truisms that at least I see in the sentiment in D.C. It's generally that there's incredible bipartisan support for reducing drug spend in general, in addition to ensuring that whatever it is you are filling and whatever that price is transparent and it's very clear. I do think that we're going to see more of that in some semblance of legislation in 2025. Again, knowing that it is one of the rare areas where there in fact is bipartisan support. And as I think about those two things, both affordability in combination with clarity and simplicity, that is just a space that GoodRx is already playing in and has additional opportunity in partnership with, you name it, trade association, government entity, to continue to be that true front end that consumers are trusting today.
And Wendy, we only have time for one more question. And as we said at the start, you just took over, but I do want to talk about the long-term share performance, because GoodRx shares are down 87% over the last 5 years. They fell another 7% yesterday with the news that your CFO is departing. At this critical juncture for the company, I mean, what would you say to investors to reassure them?
Yeah, no, it's a great question, and candidly, it's where I'm spending a lot of my time at the conference. Here's what I would say. The opportunity with brand pharma, the opportunity with retail pharmacy, the opportunity through funded payers, whether PBM or not, the opportunity direct to employers and health plans that largely we're not working with at all today. Those opportunities, when you put those together, simply answer a lot of the questions around drug friction. I believe if we continue to perform quarter over quarter and hit our numbers and guidance that we're putting in the market, we will return investor confidence as we execute. We're going to be coming out of 24. We've already demonstrated growth thus far in 24. Final earnings will be, I think, February 27th. We're going to be able to stay on plan as we said we intended to. We're demonstrating growth. There's great opportunity here. And so what I would say to investors is watch us execute, and I expect the stock to follow suit.
Well, that's a good place to leave it. Really appreciate you taking the time. I know this is a busy conference for you. That is GoodRX CEO Wendy Barnes. Back to you, Romaine.
All right, great job out there in San Francisco. Katie Greifeld, some breaking news here back in New York involving Intel. The company says it's going to separate its venture capital arm, Intel Capital, into a standalone fund. Now, this venture has about $5 billion in assets under management. The company is saying that it will remain an anchor investor in the new company, though it will be renamed. It says that the standalone operations are expected to begin sometime in the second half of 2025. Bonnie?
As you can see, the stock of about 0.6% after hours, but that was in a session where we saw a lot of downdraft. Let's take a look at how markets finished the session today on Wall Street. And the S&P 500 did finish up about 0.1%, but there was a lot of flip-flopping throughout the session. We were lower and higher. As you can see, the Nasdaq didn't manage to make it back into the green, up at some points in the day, but finishing the session down about 0.1%. Most of the companies in the stocks, the Philadelphia Semiconductor Index, were lower, including Nvidia. The 10-year yield, 478.83, not much movement there after the huge moves of recently. And the dollar index, while it did weaken the US dollar after that news that tariffs might be incremental and marginal, it actually strengthened once again and finished the session at 109.20. This is Bloomberg. We're less than a week out now from President-elect Trump's inauguration, but before he's sworn in, the process to approve members of his cabinet just getting underway. Senators spent the day questioning Defense Secretary nominee Pete Hegseth earlier. For more on what to expect from the incoming administration, we're joined now by Isaac Boltansky, Director of Policy Research at BTIG, and thank you so much, Isaac. So how did the day go, and what are we expecting by the end of the week? Will we have some cabinet members already basically confirmed?
I think we will. I think that we should expect Scott Bessent to do pretty well in front of the Senate Finance Committee. I expect that to be done very quickly. And ultimately, look, I think that Secretary-designate Hegseth is likely to be confirmed. And what he did today was to shore up support among Republicans, and that's all that he needs. He needs the Republicans on Capitol Hill to stick with him, and most importantly, he needs President-elect Trump to stick with him. And I think the performance that he had today means that those folks are going to stick with him for the time being. I also think Senator Rubio and Pam Bondi as Attorney General should be confirmed in the next few days. So ultimately, the president-elect is going to get his cabinet.
Yeah, so we'll see a raft of all of these, sworn in at some point. But beyond that and before that, we're going to get a raft of executive orders, Isaac. What are you anticipating next Monday? What will be the ones that we should most be watching out for?
It's going to be incredibly busy. And I think this is something that markets really need to internalize and understand. This is year 5 of Donald Trump, not year 1. They are coming in more prepared and with a more set personnel than we saw the first time around. There's going to be a ton of paper. And I think that we're going to see an enormous amount of focus on immigration and border security, healthcare, and energy. Those are 3 areas that I think you're going to see a lot on. On border security and immigration, I feel as though a fair amount of that is going to be ultimately litigated. So we're going to have to wait to see what the courts have to say. But on those other fronts, you're going to see a quick turn on the energy front. And then on the healthcare front, you're going to see an enormous amount of actions as well. I'm also interested to see what I'm expecting, which will be a return to office executive order from the administration meant to start the process of going after the federal workforce, which I think is going to be a theme throughout the Trump 2.0.
Well, that's what I'm curious about here, Isaac, particularly when it comes to the federal workforce, a workforce that, I know, despite what some people think, actually does work. A lot of these proposals, I mean, there is a follow-through that is needed on that, and it's a follow-through that is not necessarily political. There's a political side of Washington that but there's also the administrative side, the getting things done. And I do wonder whether they've taken that into account or whether they just don't think it matters as much.
Yeah, look, I think that throughout all of this, Roman, one of the things that I spend a lot of time doing is trying to understand the difference between rhetoric and reality. And that's a lot of what we're going to see in these first few months. There were a lot of campaign promises that simply will not happen and cannot happen. And there's an area here that I'd like to highlight with you on the federal workforce. Roughly 70% of the 2.1 million federal employees work in defense or national security. Yeah. And so it will be incredibly difficult to see major reductions in workforce in those fronts, right? So I'm with you on that. I do think that there are other areas where Trump 2.0 would be more than happy to see some natural attrition. And I think that's one of the things that you're going to get from this return to the office EO at the outset is looking for some natural attrition in other areas of the government. But look, it's a huge hill to climb to see massive reductions in the federal workforce, especially given that 70% of them are in those jobs that I mentioned.
Yeah, and we talk a lot, of course, about political capital and where you expend that political capital. And I guess I kind of scratch my head. I wonder if that's where you want to expend it, particularly given all of the things that he wants to get done over the next 4 years, or at least the next 4 months. It sounds like he's going to try to cram it all in. I do want to just pivot real quickly here, Isaac, because we only have about 2 or 3 minutes left. I do want to talk about TikTok, because we are still waiting for a formal smoke signal, white smoke out of the Supreme Court building as to whether TikTok will have to be sold or not. And I do wonder about the interplay in the Trump administration, because there are a lot of people in his administration, or coming into his administration at least, that seem to be more in favor of keeping TikTok alive, even though there's, of course, a lot of criticisms about Chinese ownership of it.
Yeah, look, I think that we have to stick with the statute here, Romain. And when I think about what the Trump administration can do, I think that they're incredibly limited in their options. So first, let's take a step back and say we're all waiting for the Supreme Court. Our base case since March has been that TikTok, the statute will be upheld, and that TikTok will not be allowed to operate as is. That's been our base case. I think that's still true after hearing the oral arguments. My sense, though, is that the Supreme Court is going to give TikTok a brief reprieve, and they're going to say we're not going to decide this right now. We're going to give them a few months, perhaps till the end of the term. And then once we look at that landscape, I think that TikTok's going to have to think seriously about finding a suitor domestically, because ultimately Trump can't save them. The statute is very clear on that front, and there's just no way around it.
Yeah, absolutely, Isaac. And we had a great write-up here by our folks over at Bloomberg Intelligence saying just that. Isaac Boltansky, Director of Policy Research over at BTIG. And, of course, one of the big things, Vonnie, that we are keeping an eye on is that Supreme Court decision. There's been so many rumors Elon Musk might buy it. Of course, we've heard about the bid that Frank McCourt and Kevin O'Leary say that they would certainly step in and buy it if they were given the opportunity. Kind of what's the future of this?
Look, it has the eyeballs, right? Wouldn't you want to buy it if you had the ability and the capacity and the capital to be able to buy it? And, Elon Musk could make the argument that he could stick it with X and it would be another Instagram type of app.
Well, the clock is ticking on that. We'll keep an eye on that. And in the meantime, though, we do also want to set you up for some of the other things to keep your eyes on over the next 24 hours. We'll have that for you when we come back after the break. This is Bloomberg. All right, welcome back to the close. And Vonnie, we were talking a little bit earlier about how volume was actually somewhat lighter than what it would normally be. People kind of in a little bit of a holding pattern, and a big part of the reason there's a lot of catalysts about to hit this market over the next 24 hours. And that actually includes the start of earnings season. The big banks set to start reporting tomorrow morning.
Can you believe it? It's the middle of January already, and we're back into fourth quarter earnings season for Citigroup, JP Morgan, Goldman Sachs, Wells Fargo, even BlackRock. But Romain, as you know, we've seen a huge run up for many of these stocks, but they do have room to go. I mean, if you compare them with the likes of Nvidia or some of the other, large mega caps and so on, they've obviously.
And I was taking a look at some of the estimates, particularly for BlackRock, JP Morgan, and of course Wells Fargo. We're going to have an interview tomorrow with the CFO of Wells Fargo, Mike Santomassimo. The idea is that most of the analysts covering these stocks, they're pretty bullish on what they think they're going to hear out of these companies, not only for the quarter that just passed, but for their forecast going forward. And I think that's going to be key because everyone really wants to know not just the numbers that they're going to forecast, but of course the commentary about the new administration and new regulations, or maybe deregulation.
Well, exactly. The hope is that there's going to be deregulation, that it's going to be the end of Basel III, that they're going to be a lot more friendly to banks, people in agencies and in commissions and so on. But that all remains to be seen, Romain. And of course, there is higher for longer as well now as well.
Yeah, and of course, the other big event tomorrow is going to come at 8:30 a.m. out of Washington. And that is the release of that monthly U.S. Consumer Price Index. And of course, that comes 24 hours after we got a producer price index report that did actually show some moderation in wholesale inflation.
Yeah, we're looking for hopefully a softer CPI report as well. That would help the Federal Reserve to continue making its case. And of course, we're going to hear from many Fed speakers as well throughout the rest of the week, including Thomas Barkin, Neil Kashkari, John Williams, very importantly, of the New York Fed, and Austin Goolsbee.
Yeah, and it'll be interesting to see the interplay, though, too, because we talk about this idea, Vani, of kind of what is the reaction function by the Fed. I mean, even if we do see an uptick in inflation, which in CPI, which some people think we might, is that really a signal that the fight has been lost and the Fed should either start raising rates or at least keep them where they are? Does that sort of disrupt the rate easing cycle that we were in?
Exactly, and it's backward looking as well, right, Romain? In the last few weeks, we've seen a huge injection of basically price into energy names and into WTI, for example, natural gas, and you've got to worry about that going into inflation dynamics in the future as well. And keep in mind that CPI report comes a day before we get the retail sales reports, and then of course we're going to stay in Washington because all day long we're going to have additional Senate confirmation hearings for President-elect Donald Trump's cabinet, and that includes two that should actually get through. We're talking about Marco Rubio and Pam Bondi. We'll have full coverage of that right here on Bloomberg. Tune in tomorrow for all of your politics coverage, or just stick around. Balance of Power is up next.